Greetings, friends. Hey, look, I've been getting a lot of questions about what we're doing in today's marketplace in terms of investing. And what I wanted to do is do a really quick video and share with you 6 graphs that talk about where we think the market is today. So without further ado, and in the interest of saving time, um, let's make this happen. By the way, thanks for showing up. Hope you're having a great day. It's a beautiful November 22nd. Unbelievable, by the way. It's amazing how quickly this year has gone. So this is the first chart. It's a chart of M1. M1 is the primary money supply in the US, and here's the scary part. Even after the great financial recession, we only doubled M1 from 2 trillion in 2009 to 4 trillion in 2020. But in 2020, roughly around April and May, we jacked up M1, which is money in circulation, by 500% over an 18-month period, 500%. It's the greatest and grossest economic experiment ever in the history of the world. And our Federal Reserve massively overreacted to what was happening. Chart number 2. This is a chart of interest rates. This proxy is a 30-year fixed rate mortgage going back to 1960-ish. Note that it peaked during Paul Volcker's term at the helm of the Federal Reserve, and he was doing his best and did a laudable job, although misguided in my opinion, of crushing inflation. Subsequent to that, you can see that interest rates have steadily declined over the last 40 years. That makes sense for a variety of reasons, including we're better at managing our risk. We also offload our risk by securitization. The Federal Reserve, through quantitative easing, was directly responsible for bringing interest rates effectively to zero for the Fed funds rate, which artificially lowered interest rates on virtually every asset class, whether it's commercial real estate, single-family real estate, credit cards, auto loans, etc. When they stopped quantitative easing, when they stopped buying securities associated with those debt instruments, interest rates went through the roof, because this up here in the 7% range is where they naturally want to be today. The bad news is the Federal Reserve is engaged now, or will be soon, in what's known as quantitative tightening. And so what they'll be doing is taking those securities that they have on their balance sheet and start to sell them into the marketplace, further increasing rates. What makes that worse is that the Federal Reserve, in their infinite wisdom, has risen or grown the rate of the federal funds, has increased the federal funds rate by the fastest ever known in history. And I'm not talking about history, period, since the Federal Reserve existed here in the US. That has had a devastating effect on demand. Demand destruction, it should be the new buzzword today. Interest rates have a direct effect on virtually every asset class, whether it's single-family homes, and you're aware of what's going on there. That market is being destroyed almost overnight, solely as a result of federal funds monetary policy. They got us to the point that we were at, which is the bubble of everything in the economy. They absolutely inflated assets across the board, whether it's single-family homes, the stock market, commercial real estate, used autos, all that stuff went through the roof, on average about 40%, simply because they put too much money into the economy too fast, left interest rates way too low for too long. That is the primary trigger for inflation. No question about it. They caused it. Now they're trying to hit inflation over the head with a freaking sledgehammer. And by the way, it's working, but it's causing massive disruption here in the US. By the way, Federal Reserve is responsible for 3 things. First thing is price stability. Let me ask you, how did they do with price stability over the last 2 years? Absolute failure. Prices have gone through the roof, and they've been extraordinarily volatile simply as a result of their monetary policy. 2, they're responsible for stable inflation. Has inflation been stable? No, it's the highest it's been in 40 years. And 3, they're responsible for a steady unemployment rate. And have they done well? They're absolutely not. The answer is unemployment is way too low. And what it's done is essentially caused massive wage inflation. The good news is it's for the lower income earners, and I think that's great. The bad news is it's put the negotiating power in the hands of the employees, who get to say, as an example, no, I'm not going to come into the office today. And if you make me, I'm going to go down the street, hire on with them, and get a 10 to 15% bump in compensation. Look, the bottom line is the United States economy, our gross domestic product is primarily consumer driven. 70% of the US GDP is as a result of you and I buying goods and service. Note here in this chart, which is the personal savings rate, that as a result of all that stimulus, personal savings rates went through the roof. This is PPP and individual stimulus checks, amongst other things. What we do as consumers is we spend. That's what we've been indoctrinated to do today. So we took all that wealth that was transitory, and don't think transitory in the terms of the way the Federal Reserve called inflation, which was a ludicrous statement at the time, and we all knew it. We took all that wealth, which was temporary or transitory, and spent it. So at this point, our personal savings rate is at or below an all-time high going back to before 1960. That sucks, because here's the answer ultimately. The US economy is consumer driven, and consumer wealth and sentiment play a major role. Consumer sentiment here, as tracked back to 1975-ish, is at or close to an all-time low. So what happened? We blew up bubbles in every asset class as a result of really misguided Federal Reserve policy. How Jay Powell is still at the helm there, I have no idea. If it was in private sector, he'd be fired. He would be taken out to the woodshed and be done with. But we can't do that because the Federal Reserve is a private for-profit entity. In any event, our economy is in for massive devastation. I would generally make this statement, and by the way, this is semi-informed. My undergraduate and some of my graduate work was in economics and statistics. This will be my fourth major downturn. I am a banker, investment banker, an investor, and a venture capitalist. I've done more than $11 billion worth of transactions over the course of my life. I'm not saying I got it right. One thing I know is that I know nothing. Very Socratic in that approach, but what I can do is look at history and say, this is what history tells us about the future. And if we don't do that, by the way, we're bound to repeat it. And we're really good at repeating history here in the US. In any event, guys, look, that's what I see happening. A lot of people are saying, is it now a good time to jump into the stock market? Well, look, generally speaking, it takes 2 to 4 years for markets to bottom. Whether it's the stock market, whether it's the debt market, whether it's the real estate market, it takes years to find bottom. This is a chart of a typical business cycle, but it's based on emotions. And by the way, again, we're an emotional-based society. We buy when things are going well, and we start to freak out when things are going really poorly. Ultimately, we end up in capitulation. So here's the cycle. Optimism leads to excitement. Think about Bitcoin as you look at this. It's trading at $5,000 a coin or $8,000 a coin. It's $20,000. Now it's $60,000. Now it's $64,000 a coin. 800% of its baseline cost with no barriers to entry. And then, it's starting to roll over. Anxiety kicks in, then denial kicks in. Oh, this is a temporary setback. I'm a long-term investor. Then fear, desperation, panic selling, and ultimately capitulations. Maybe the markets just aren't for me. We end up with despondency, and this is the maximum point of financial opportunity. From there, we start to gain momentum to the upside. This cycle occurs every 7 to 12 years consistently. And look, guys, it's happening again. My perspective today is we're not investors. We're not buyers. We think we've got a long way to go to the downside. Based on history, we believe we're going to see massive discounts to today's values, which are going to be potentially once in a generation opportunities to buy. I don't care what your asset class is. We do commercial real estate. We buy non-performing notes. And historically, look, commercial real estate has been the single best investment opportunity. And therefore, we're really looking forward to this. As Albert Einstein said, there's great opportunity in every crisis. As Warren Buffett said, you sell into greed and you buy from fear. As Baron von Rothschild say, you buy when there's blood on the street, even it's your own. Guys, my recommendation is now is not a time to be investing, but now is a great time to be in preparation. Husband your resources, minimize your expenses, prepare to invest. So build an investment thesis, build a plan so you can trade your plan. That's, again, just my opinion. It's semi-educated based upon 30 years of investment history. Some of it's worked, some of it hasn't. But I hope that's been valuable for you. It's Been a pleasure. If you have any questions, let me know. In any event, God bless you in your investing strategy.